I'm honored to have you on the phone. Marc Faber, for our German customers, is the publisher of the Gloom, Boom, and Doom Report. He is a legend. He has an impeccable track record over, well, 3 decades. In my own particular case, he helped me, inspired me to sell shares in my own company, VMR, Value Management Research AG, in 2000, and animated me to start a hedge fund, which was bearish in 2002. That was the top performing hedge fund in Europe with a return of 30% and a crash year of minus 35%. So, Mark, first of all, I want to thank you for your, you're really unorthodox, but very, very serious and accurate thoughts. And I will start out by asking you on your take of Trumponomics, and in particular tax reform and lower taxation that has been the driver in many countries in the past for better corporate earnings and for better economic growth. Let me hear your thoughts on that aspect of Trumponomics.
Well, first of all, maybe I'm the wrong person to ask, because I think both in Germany and in the US and in most countries, the tax system is far too complex for ordinary people to understand. And as you know from economics, if I levy a tax on someone, he can, depending on economic conditions, roll over that tax onto somebody else. So the tax incidence is not clear cut. But in general, I personally, having worked and also visited numerous countries with a flat tax rate, I'm of course in favor of a simple flat tax on income and no deductions and no exceptions, but just a flat tax. And then you can still have, say, a value-added tax, which economically is probably the fairest tax. So tax reform, in the U.S., whenever I hear reforms by bureaucrats, they scrap certain aspects of regulation or of taxation, but then they introduced other ones. And I have never seen really bureaucracy shrinking. The only way that I've seen bureaucracies is getting larger and larger and more cumbersome. So I take these tax reforms with a grain of salt. Secondly, we had previously tax reductions on the Bush and so forth. And it's far from certain that the corporation which obtains lower taxes will actually invest money in productive factors. They can also use the tax savings to buy back their own shares, or as we've seen in the US, for all kinds of financial engineering that boost essentially earnings per share, but have a rather negative macroeconomic impact. So I'm, relatively cautious. Secondly, what investors must understand, say, if the official corporate tax rate, I think at the present time is something like 39%, but the effective tax rate that corporations pay is much lower. It's around 25%. So the tax cuts may actually have a very muted impact on corporate earnings, which depend on many other factors, including interest rates, wages, and of course for the multinationals, and probably close to 50% of S&P earnings come from outside the U.S. They also depend on the U.S. dollar exchange rate.
I really appreciate your comments because prior to this call, we did a basic analysis of the tax rates of the 10 largest members of the S&P 500. And you're quite right. We found out that the effective tax rate of those companies, at least, is only 16.4%. And that might.
Yes, I mean, if you look at the tax revenues in the U.S., the tax revenues in the U.S. have gone up for individuals, and not the richest individuals, but say upper middle class. Say if you're a doctor, it's very difficult to cheat on taxation for you. If you're a billionaire, there are many ways how you can reduce your taxation. And as a percent of the economy, corporations in the U.S. have had declining tax payments to the government as a percent of the economy. So actually, they don't pay the 39% or what the official tax rate is.
Yes, again, completely correct. On every $100 in tax collected in America, only 3.7% at most come from the corporate sector. That's truly an anomaly, would be an anomaly in Europe. And it's entirely possible that if the tax rate is lowered, the effect might not be as great. But the stock market seems to like the Trump story a lot. And using clean US GAAP earnings, not the stated earnings or the fabricated earnings or the so-called operating earnings, we're dealing with a 25.6 price earnings multiple for the current year and 8 declining quarters of corporate profits at the US GAAP level. The question really is, we saw your Bloomberg interview and we're very impressed. You said that this is probably or possibly reached an inflection point in valuations. Is that how you feel? Do you feel that the valuations are so important that we might be near market top, or are there other reasons, other major risk factors you see at the present time?
Well, I mean, let me answer the question this way. First of all, of course, I would have chosen anyone to be president over the Clinton clan. That is a corrupt clan. To compare them to the mafia is an insult to the mafia. With the mafia members, they have some honor. The Clintons have no honor whatsoever. They are thieves, low class, small town thieves that just were in a position where they could take a lot of money through being in essentially the political environment that we have in the U.S. But Trump, unlike, say, Reagan, he faces, and that's not his fault, but he faces huge headwinds. One of them is when Reagan became president, he was elected in 1980 and became president in January 1981. The valuations of stocks, real estate, bonds were very low. You may recall that in the U.S. Treasuries in 81, they were yielding more than 15%. The stock market in the U.S. in 82 was below, at the low point in August 82, was below 800. And it was no higher than it had been in 1964. So inflation adjusted, it was at a very low level. There was very little speculation at the time, and nobody believed that stocks would ever go up. In other words, sentiment was very negative. And real estate, because of the high interest rates, were of course, real estate was of course also depressed. In other words, inexpensive. Art prices were depressed. Everything. Trump, he becomes president in an environment that is completely opposite to Reagan. Not only are, as you just pointed out, U.S. stocks by historical standards expensive, as you said, 26 times earnings if you take the correct earnings. And you also have a grossly inflated bond market in the world. And whereas credit or debt as a percent of the economy when Reagan became president was just 140%, now it is more likely around 300%. But that excludes the unfunded liabilities, about which politicians prefer not to talk, because the country is basically bankrupt, including the unfunded liabilities. So Reagan, he actually became president in a very fortunate time. That was followed by disinflation, the breakdown of communism, socialism, that then led to 3 billion people in the world entering the global economy, the market economy, the capitalistic system. And all these factors were very favorable for the subsequent 20 years. I don't see any similar favorable factors for the U.S. over the next 10, 20 years. In fact, I think the U.S. faces huge headwinds. And so I don't know where the market will be in a year's time, simply because you and I, we don't know how much money they will print in among the central banks. The U.S. has no longer printed money, but they haven't reduced their balance sheet. But when the Europeans, when the ECB and the Bank of Japan and the Bank of England print money, some of that money obviously flows into U.S. dollars and boosts U.S. dollar assets, including also the dollar. So the money printing doesn't really matter whether it's in the U.S. or in Europe. But my suspicion is that it will resume at some point in the U.S. when you have a recession or when the markets will go down. And then there is the factors to consider. By historical standards, the economic expansion is now 91 months old. Historically, the typical expansion in the U.S. between the phase of growth and then the next recession is 45 months.
Oof.
The bull market is one of the longest bull markets in history. March 2009, by March 2017, this year, in 2 months' time, will be essentially 8 years old. So we are at the tail end of an expansion. The expansion has been weak, admittedly, but it has been very, very good for asset holders, for wealthy people, including you and me, and of course for corporations who in this money printing environment benefits the most through rising corporate profits.
I hear you.
To buy stocks,
yeah.
I would rather buy stocks in Europe and in emerging economies where, relative to the U.S., stocks are much cheaper.
Yeah, certainly. But that goes to your and my old experience over decades that if America, the stock market in America has a cough, emerging markets and parts of Europe have a nosebleed because the betas are, often quite a bit higher, and they follow the U.S. market in a sharp decline or a noticeable decline in the U.S. Do you think that some equity markets around the world might escape that trend and not get a nosebleed?
Well, I mean, this year, okay, we had markets that went up, but some markets went down in dollar terms, and others, like Brazil, up 66% in 2016. Yeah. Russia up 55% in U.S. dollars in 2016. Some markets have really performed better than the U.S. So Thailand was up 19% in U.S. dollar terms.
True.
I think also I would rather invest in emerging economies. And I also believe that over the last few years, there was one overwhelming trend, which was indexing. All the money that flowed into funds went into index funds. I believe we're moving now into an environment where sector selection and stock selection will be very important. So you could have the index go up or go down, but some stocks and some sectors will go up and some sectors will go down. For instance, the media, the mainstream media, and the fund managers, they don't talk about it. But actually last year, the best performing sector in the U.S. by far were gold mining shares, precious metal stocks. But that they don't want to talk about because they were not positioned in that sector. They were positioned in the FANG stocks that didn't do anything. So I believe 2017 will be very important in what kind of sectors you will be. It will be very important also, are you long bonds in the U.S. or are you long the U.S. dollar or short the dollar? I think if you look at the performance of the U.S. dollar last year, in the first half of the year, the U.S. dollar against the euro was weak and also against the yen. But in the second half, the dollar then strengthened considerably. So you had two major trends, weakness in the first half and strength in the second half. And I think these are the big macro plays, essentially. As an investor, whether you're overweight dollars or long dollars or not is a very important point to consider. I happen to believe that this blind faith in U.S. dollars is misplaced. I would rather be short the dollar than long the dollar. But as you know, the majority of investors today, they think that U.S. treasuries are toast. In other words, they're negative about U.S. treasuries. They think yields will go up, and they're very bullish about the U.S. dollar.
Well, the consensus isn't always right, and I think you and I have made a living on beating the consensus. But let me ask you this. This leads to the next question, obviously. Your take on 10-year and 20-year and 30-year interest rates in the U.S. We find that there is quite a trend developing where the demand is flatlining and the funding requirements at the U.S. Treasury are really going up steadily. What's your take on demand supply or the development on, let's say, the longer term durations on the U.S. government bond market?
Well, I mean, as I said, interest rates in the U.S., they peaked out in 1981. So basically, we're in a 36 years bull market for bonds, and interest rates went down, and they bottomed out last July on the 10 years. I think it was 1.34%. Yeah. And now we went to over 2.5%, and we're there about at the present time. The consensus is that interest rates will go up. And of course, I agree that eventually U.S. interest rates will go up. But you and I, we don't know what the Fed will do. Sure. And the funding requirements, they're already very high today. The government debt in the U.S., which is the way you described corporate earnings, the real government deficit is the increase in the government debt between, say, January 1st to December 31st. Yeah. And over the 12 past months, over the last year, the U.S. government debt increased by more than $1.5 trillion. So that's essentially a more realistic deficit figure than what the budget office is publishing. but that doesn't include the increase in unfunded liabilities.
Sure.
So the deficit is even larger. In short, my sense is that the Trump administration, who wants to make America great again and so forth, is faced with the choice of rising interest rates and a strong dollar, or money printing and a weaker dollar. They will probably opt for the money printing. And the money printing will then be in a form where the Fed essentially buys government securities. In other words, they can monetize, like in Japan, the entire government debt.
Okay.
And under these conditions, and also under the conditions I just explained about the expansion being so old, in other words, a recession is more likely than unlikely.
Yeah.
Under these conditions, I think that maybe we haven't seen the ultimate interest rate low. Furthermore, put yourself into, say, my position as an international investor. I can buy Spanish bonds, Spanish government bonds, or Italian government bonds, and I can buy U.S. Treasuries with a higher yield. I can buy U.S. Treasuries with a significantly higher yield than Japanese government bonds and Swiss government bonds, German government bonds,
Sure.
Dutch government bonds, and so as an international investor, if I want to have an allocation to fixed interest securities, and as you may know, I'm in favor of having a diversified portfolio consisting of real estate, equities, bonds and cash, and precious metals. And each individual has to decide himself the precise allocation, but I suggest roughly a quarter each. In the allocation for bonds, I'm not so negative about owning some U.S. Treasuries, especially not over the next 3 months. I think the economic news will deteriorate very badly because the Obama administration probably lied massively about everything. And so the economy, if you look at, say, what is happening in the retailing space, in consumer spending, if you look at all these things, then I think that the economy will actually disappoint and that treasuries will certainly rally to again, say, below 2% yield. So I think you could make 5-10% on your long-term treasuries.
I like that contrarian investment idea.
But understand, I'm also negative about the U.S. dollar. So I think that maybe you make some money on treasuries and you lose it on the dollar exchange rate.
Yeah,
But ultimately, you and I, we don't know how the world will look like in 5 years. I mean, you know, you look at someone like Merkel. I will never understand in my life how, when the majority of Germans are completely or is completely against immigration, a politician can implement the policies she has implemented and how she is actually likely to win the next election as well. I personally, I would be surprised if she wins the next election, but for me, it's mind-boggling how the Europeans fought for their moral and ethic standards for centuries. And suddenly they let in an unlimited amount of essentially, in quotation mark, refugees, who the majority of whom is not prepared to work. They don't want to work. They don't want to integrate. So you can be all in favor about immigration for people who say, okay, we accept that we are in a country, we are guests, and we have to adapt our lifestyle. If you and I go to the Middle East, to Saudi Arabia, to Dubai, to Abu Dhabi, Kuwait, you and I also have to adapt our lifestyle. But the Europeans, they're brain damaged. They think that we Europeans should adapt to their lifestyle in Europe.
It's not a good idea to not adapt in the Middle East to the local lifestyles. I've visited and lived there, and I don't think I would want to smoke a joint or do some coke or get smashed in Fez or in Medina.
I can't drink my 10 beers a day in Saudi Arabia. I can't have my refrigerator with my beer at the office.
So I get your take on various scenarios. Let me hear your views, because you're in emerging markets. The story is strong. The earnings are more dynamic. These countries might grow on their own. They have a lot of catch up to do. I'd love to hear your views on the red tiger banking and shadow banking situation. Is that the threat it is made out to be by many, such as people I regard highly, David Stockman, Jim Rogers? What's your take on the China debt situation?
Well, I mean, I think the current monetary arrangements, obviously, they will end badly, this money printing. I can't imagine how, under any scenario, it will end well. But you understand?
Yes.
Between 1998 and 2015, the balance sheet of the major central banks increased 16 times. Who is to say that it can't increase another 20 times, another 50 times, or another 100 times, or another 1,000 times over the, say, next 20, 30 years? You understand?
I understand.
With money printing, you can postpone a lot of disasters. But what happens in money printing regimes is, and this has happened in the US already and to a large extent in Europe as well, under a money printing regime, the money that is printed, and this was already observed by Copernicus and Hume and many classical economists, the printed money doesn't flow evenly into the economy. And so what happens in a money printing environment is that the working class and the middle class is lagging behind. Their real wages is declining, their real wealth is declining usually, and the income of the big asset holders, not the 1%, but the 0.01%, they benefit the most. That's why the financial sector became so prosperous. If you look at the list of richest people nowadays, most of them are not people that build something, but they are asset shovelers. They were very good at buying and selling companies and at taking advantage of the freshly money printed by the Fed. And in my view, this can go on for quite some time. I mean, we have, by historical standards, very high wealth inequality, very high income inequality. But who is to say that it's finished tomorrow? It could go on for a while.
I'm with you, but let me close on this question. Take the scenario Trumponomics doesn't quite work. He has to make a lot of compromises on Capitol Hill to get his infrastructure plans through, whatever he's planning with the tax cuts. And then the economy sputters, as this might take a year or two to unfold. Yellen comes back and says, let's start another bout of quantitative easing and helicopter money. would that not result at some point, at least, in a crisis of confidence?
Well, the crisis of confidence will first be visible in the US dollar weakening.
Mm-hmm.
And I suppose that when the dollar weakens, the appetite for US assets will also diminish.
Mm.
And so my view would be if you want to own equity, so if you own equity,
Yes.
I would now essentially use the dollar strength to reduce my positions in the US. I only own mining stocks in the US anyway,
Okay.
but I would essentially overweight Europe
Mm.
and I would overweight emerging markets, in particular in Asia.
Hear you loud and clear, Marc Faber. It's been an absolute joy to have you on the phone. It's a privileged conversation. I wish you all the best for this year and, of course, thereafter. And thanks for having you.